I'm Mandy Chang from the Ecopreneurship team here at Stanford. We all know that great climate solutions don't scale without capital. But with a rapidly shifting funding landscape, even the most promising founders are navigating new challenges. To help ground us in where we are and where we're headed, we're kicking off with a primer. It's my pleasure to introduce Sophie Purdom. She's the managing partner of Planeteer Capital, where she backs early-stage climate tech founders with a focus on hardware-enabled software. Planeteer's $55 million Fund 1 is anchored by an Ivy League endowment and Meta's former CTO. Sophie is also the co-founder of CTVC and Sightline Climate, widely recognized as climate tech's source of record, with over 70,000 subscribers and features in the New York Times, Bloomberg, Financial Times, and more. Previously, Sophie launched an ESG fund at a major endowment, published a book on sustainability in investing, worked at Bain, and helped raise $65 million at Kula Bio to scale carbon-negative fertilizer. Please join me in welcoming Sophie to the stage.
Thank you. All right. Hi, folks. Can you hear me okay? All right, we've got the fills. So this is going to be a heavily caffeinated, fast-moving primer on the state of climate tech investing. And in fact, we're going to talk about how that space is evolving, which I don't know about you guys, but that feels like that's all happening very much in real time. So the basis of this presentation comes from a few unique data sources. Does this branding, does that little square with the CTVC green icon in it, does that ring a bell for anybody? Is anybody a CTVC subscriber in the audience? We see that, woo, amazing. Thank you for reading, awesome. So for those of you who might not yet be a subscriber, CTVC is a newsletter. It's free. You can go subscribe to it at ctvc.co. I promise this is not a marketing pitch. And it stands for Climate Tech Venture Capital. This is a blog that about 6 years ago, a team of us started writing to cover essentially the evolving landscape of climate tech. A lot's happened over that time period. We've put out, I think, over, let's see, when did I screen grab this? 241 weeks in a row of newsletter content, and increasingly more and more of these insights, which are incredibly nerdy, incredibly deep dives into markets, into where's the capital flowing, and into kind of predictions for the future. So feel free to check it out. We would not have been able to keep writing all of that content consistently for, the past 6 years if it wasn't backed by data. And so these are some super quick shots into what does that look like on the back end of our essentially fancy Airtable. If you try out that QR code, this is my first time trying to do this in a presentation, I think it should take you to our homepage so that you can avoid typing all of that in. But grounding you guys back, this is the back end of us tracking every transaction that happens in climate. And as you might imagine, if we have all the transactions, then we've got pretty neat profiles, pretty comprehensive profiles on all of the companies in climate. And if we've got that, then for the VCs in the audience, we have profiles on you guys too. So why does that matter? What does that allow us to do? Well, we can come up with some pretty graphs that look like this, right? What's been happening since 2020 in the climate tech space? We've tracked $182 billion of deployed capital, which is, vastly greater than all of the Clean Tech 1.0 deployed capital. And we see this splitting out into about 7 different sectors. What does that look like in one giant, beautiful Marimekko? It shapes up like this. This is probably my favorite chart of all of the ones that we're going to flip through together because it's a single kind of pretty comprehensive picture. It's hard to figure out what is climate tech, right? It's a theme, not an industry. And so this is our best attempt to show you the 7 industry verticals and then to call out some of those subsectors within it of where is the funding actually flowing. And so this one, right, 80% of that funding goes to just 3 of those 7 sectors. That's pretty heavily weighted towards, important aspects like, new transportation forms to move us around in a clean fashion and energy, storage. We're seeing kind of nuclear pop up on there, food and land use, of course. But here's a neat kind of party trick. If we take that same database, right, of all of the deals, but instead of looking at the dollars deployed, We instead look at the count of companies. It's a different picture. So same data set, but different flip. And this one's actually my favorite slide, because this shows all the founders. So in 2024, so just last year, we tracked over 1,000 new companies being formed in climate. And as you look at this slide, you might find some of those sectors that most align with you. Maybe you're building in that space or excited to back companies in that space. And it's a nice moment to kind of look up and out at this broader landscape. There's a lot we have to do. There's a lot we're already doing. And so excited to see how this slide in particular shifts over time. All right, enough of that. Here's a big asterisk before I flip through a whole lot more kind of slides. We're talking about the evolving climate capital stack, which is incredibly layered. This is a best attempt at showing a kind of high-level visual of how that capital stack or those sources of funding might change for a company as it progresses kind of out of the lab or out of the pitch deck phase through into demonstrations and ultimately kind of to scale. Those capital flows shift as the maturity of the business itself shifts, right? And the big asterisk here is that our data, so the slides that we're going to flip through together, are only focused on a couple of these slices of the capital stack. So we're double-clicking into the venture capital and the growth funding, so essentially that broader private equity bucket. So when we say numbers like $180 billion tracked over the past 5 years, that might sound big, but it's a tiny little slice, right, of the broader cap stack. We're not talking about infrastructure. We're not really talking about debt. We're not even talking about grants. If you're interested in that, we can chat later about those capital flows, but I figured for this audience would focus in on venture. All right, enough of a primer. You know where the data comes from. We've seen the big picture together. Let's kind of get into it real quick. So, investment trends. We looked at a cumulative image before. Now we're looking at a chart that shows you how this breaks out quarter over quarter for almost the last 6 years or so. And I see, and I'll be curious if you guys pick out different trends in this or maybe have felt different ways, but I see there being 3 different segments to this image. There's the rocket ship takeoff phase, right, from 2020 through the end of 2021, where it felt like everyone was starting a climate tech company, and the heyday was back, and the juices were flowing, and we just had a massive up and to the right swing of new capital deploying into the space. Everything was kind of getting funded, and a big focus, in fact, on EVs. Then we've got a bit of a plateau, right, from the end of 21 through to kind of end of 22, where still lots of deals being done, still lots of dollars being deployed, but it's not growing anymore. And I think the market didn't quite catch up to the fact that we had stagnated, but it was still going strong. And then since then, there's been a bit of a correction. And I don't want to call that, this is not a bubble bursting or anything. This is a real kind of slow and steady correction out of the zero interest rate phenomenon period and back to what I think feels more like reality. So the gray line, right, is the count of companies that are being formed, and then the height of the bar is the total capital deployed during that period. And so we're seeing a recorrection of deal size. We're seeing a solid balancing out of the sectoral kind of allocation, and we're back at this kind of steady state of, frankly, really where we were around 2021. Cool. Over time, enthusiasm for different sectors has changed. I don't know if you guys remember when it felt like everyone was starting a new EV OEM, right? And then we had the SPAC boom. Those days are over. Look at that drop off, right, of what the funding into transportation has looked like over the past few years. I think now is the time of energy having its own, not resurgence because it's always been steady, but real takeoff point. And we'll click more into some of those specific deals later on. Food and land use, we had our boom in alt proteins. That's kind of recorrected back down. Industry, slow and steady. Frankly, if there's a place where I could point out a misallocation of impact to dollars deployed, the biggest gap, it's in that industry bucket. then we've got built environment, climate management, carbon asterisks, right? Small segment, though it gets an awful lot of airtime. Cool. So why did I call out energy? Well, if we just do a simple filter of the top 10 climate deals last year from like a deal size, lots of these look like clean firm power data center in orientation, with an asterisk of course, the top deal is a funky one. That's our friends at IM Motors, which is interestingly a Chinese EV manufacturer. So you'll notice that a lot of like big activity is happening outside of the US, right? So there's big deals going on, and yet it's really that growth investment where there's been a decline in the total dollars flowing into the space. So remember we were looking at that chart of quarter over quarter, how much capital is flowing in. The drop-off is a bit of a kind of tale of two markets. Early stage, and I'll show you a slide on this in a second, is going strong. We've got a lot of new companies coming to market, a lot of founders building new things. Round sizes are pretty stable. And then on the other side, we've got this picture, which is those growth investors who naturally are deploying more dollars per deal, right? They're much bigger, later stage investment opportunities. That's been dropping off pretty precipitously. And I think that's fair to say this is not unique to climate. This is driven by the fact that the IPO market's been pretty quiet and the chance to exit has been slow for a while. And so if you're a growth investor, you're essentially investing ideally right before you hit some version of liquidity. And when there's no liquidity, the first to turn off will be growth. And you're seeing that steady kind of trickle. Granted, it's a bit of an inefficient market, right? Back down to earlier and earlier stages. But my take on all of this is kind of tale of two markets. Early stage resilient, later stage certainly not. Exits, my favorite topic, and one that we should all be talking a lot more about. If there's one thing we can do for climate tech, it's go create some liquidity. All right, there were many exits last year, 177, more than ever before, by a long shot. But those were mostly tuck-in M&A deals, right? And that's not that exciting for anybody, to be totally honest. So of all of these deals, we reached out and tried to go get the numbers on what was the size of that outcome. Most people wouldn't reply, and most people didn't disclose the size of those outcomes, which leads me to believe they probably weren't great. They weren't super significant. So I think that's fantastic, and I think we're going to see a lot more of those tuck-in kind of M&A outcomes, but that isn't what drives this flywheel, right? Like, that's not really the outcome that any of us are looking for when we're dedicating our lives to going and starting a business to go change the world, nor is that what we're looking for as an early stage investor for a kind of tuck-in outcome. We're looking for that golden goose of an IPO or ideally a big acquisition. So let's talk about what some of those look like in reality. Lots of logos, lots of funky names on this slide. If you're interested, again, just go to CTVC where we've been writing and covering all of this and have large profiles on these outcomes, and where we're going to start writing a lot more about it through a series called The Exit Interview. Fun name. So who actually brought money home? Lots and lots of, and this is a just kind of pretty selective selection of outcomes last year. We have Ola Electric, which is an India-based company, right, with the biggest outcome of the year. So interestingly, biggest deal, individual deal, Chinese, right, and then biggest exit based in India. So I think we're foolish to not be looking and thinking globally about where's liquidity kind of coming from and increasingly going. And then if we have the kind of positive outcomes on one side, we shouldn't shove under the rug any of these notable 2024 bankruptcies. Northvolt, we've been talking about that for a long time, but officially kind of officially shuttered. We've got Fisker, which in my opinion, we knew that a while ago as well. We've got Lilium, which found it difficult to produce electric planes. And then interestingly, SunPower kind of also went bankrupt, which if you'll note, that company's been around for 40 years. So bit of a shock to the system, funky stuff happening in China and funky stuff happening increasingly with all sorts of tariffs and instability. So not my favorite thing to say out loud on a stage, but I don't think that this slide is going to be blank when we come back and have this conversation next year. I think it's going to be a super volatile market, and even foundational businesses are constantly having to adapt and evolve. Which brings us to what to do about it. So the capital stack. This is a bit of a freebie, so another QR code. I don't know, are QR codes even cool anymore? I hope they work. Great, saves you typing into your browser. Anyway, when I was a founder and I was raising money from VCs, I spent way too long trying to read through the marketing on websites of who actually had money and who might want to give it to me. And so we've tried to do that for founders, and this is a public source resource of investors who are active in climate. You're able to filter it by venture, growth, PE, infrastructure, et cetera. And if you're interested in more of that, then let me know, and we have a whole lot more data behind the scenes. It's really important to note that even though we highlight, and probably up on stage with us today, are a lot of those climate specialist investors, when you look at where the dollars come from, it's actually predominantly from generalist type investors. And so that's true across all of these different verticals. And so we should never ostracize our friends and peers who have big pocketbooks, right? And who have interest in these spaces, but don't predominantly just do climate. We can't float this market alone if we just stick with our kind of core cohort and our core friends that speak the same language. We've got to figure out how to talk about these companies as just good businesses. So that's a bit of a plea from my side. A lot of fresh AUM, so a lot of new funds that closed last year, interestingly, and this is specific to the climate space, though more and more those are funds that sit at the later stages of the capital stack. So these are mostly infrastructure funds who are actually going and putting steel in the ground and deploying some of this stuff. It'll be interesting to see how that works in a volatile, funky Trump 2 type of era. Ventures stay pretty stagnant and the whole way through. So that's more dry powder out there in the market for the first time ever, dropping off a little bit. And looking at my friendly timekeeper over there, we're gonna blast through some of these evolving bits of the capital stack. I've waxed and waned poetic here about venture and about private equity. But again, remember that asterisk slide of that's not the whole picture? I might have just used up all of my airtime with you guys talking about that part, but that is not the whole game. And so scaling requires smart financing. We get very excited to meet founders who are fluent and curious about navigating the climate capital stack. I think that those founders are going to be the resilient ones who think about, partnerships, think about clever lines of credit, think about, leveraging our catalytic friends, who think about all sorts of different sources to finance their business over the long term. I think there was a bit of in the zero interest rate phenomenon, kind of ZERP era, there was a bit of a wishful thinking, right? That those 7 years often that it takes to kind of bridge to some form of stability or some form of scale, that the world was going to stay the same over those over that time period. And the truth of the matter is, even if you're a day short, right, from that bridging time period, then you lose. And that 7, 5, whatever 3-year time period, there's been crazy stuff happening. And so lots of those companies are stuck in the middle. And we'll see where that, if they're able to kind of cleverly bridge. But we love working with founders who are all about tapping into debt, hybrid, catalytic, creative financing sources, of which this is just a emoji-laden, smattering of examples. I don't have time to chat through these ones, but again, we write detailed case studies on the website, and I'd encourage you guys to reach out if you're excited about chatting through clever ways of navigating that climate capital stack, because we've got to fill the gap as our friends in the government themselves are kind of pulling back. So quick zip through the entire cap stack. What gives? Why do we matter? We've got to go fund a diversity of climate solutions. And honestly, it takes complex and ever-evolving capital stack to get us all the way to scale. So thank you very much.